The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, it's my Chanticleer colleague. He's hotter than a data centre company hunting for capital. It's Anthony Macdonald. How are you, Anthony?
I'm hoping I can be an AI beneficiary one day, James.
Oh, for sure, for sure. This week we take you inside the circus surrounding the biggest ASX float in a generation. We examine the disastrous blowups at two companies that were once considered market darlings, and we try and answer your question on what it's really going to take to end the war in Iran.
But first, James, the build-up to the federal budget on May 12 continues apace, and the big focus this week was the Albanese government's decision to rein in the National Disability Insurance Scheme. It will seek to reduce the budget of the NDIS by $15 billion by the end of the decade, in part by tightening eligibility requirements, such that participant numbers will fall by 160,000. Is this the right move, James?
Oh, I think it is, Anthony. I mean, what struck me is the rhetoric coming out of the government that actually the whole NDIS could collapse unless the spending was reined in. And I think that's exactly what we don't want. I mean, we've said many times on this podcast that the NDIS has been a good program for lots of Australians, and we want to keep the core of the good that it does. What we need to do is rein in the rorting and waste such that the program can provide maximum bang for its buck. And I think the government has decided to finally attack that. Now, this is still going to be a major bit of spending for the government going forward. I mean, we are talking about taking $15 billion out of the budget by 2030, but we'll still be spending $55 billion on this program. So it's still a major program. And yes, there will be a real human cost to the fact that 160,000 fewer participants will be eligible than we have today. You know, that will have an impact on the lives of people and the lives of families. We shouldn't ignore that. But I think the government's finally got its head around the idea that there is a lot of rorting, there is a lot of waste. In some cases, there's lawlessness going on in the NDIS that ruins the whole thing for everyone. So it's good to see the program tweaked and streamlined and improved. And we don't want this thing to collapse, so let's make it sustainable. The one little caveat I've got here, Anthony, is I'm a bit concerned that Labor is trying to sell this to us as real reform. This isn't reform. This is cleaning up something that should have been cleaned up years ago. This is not a policy change that is going to help grow the economy and make it such that Australia doesn't break out in inflation sweats once growth gets into second gear. This isn't real reform, and I hope the government doesn't try and pretend that it is, because, Anthony, this can't be the centrepiece of the budget. This is a good move in the budget. This is good to reduce government spending. We've got to see more from Jim Chalmers, don't we?
We do, James. I mean, the government's just knocked the top off the NDIS here, and it's had no choice. It had to happen. Like, it'd be nice if this marks a new era in Australian fiscal discipline, let's say. Like, the NDIS is perhaps the embodiment of the government's going to pay to fix whatever problem we've got. We sort of need to stamp that out in Australia. It's not a Liberal thing. It's not a Labor thing. It's just about responsible spending, right? It's about running balanced budgets, surpluses in good times, borrowing funds from future generations by using debt and deficits in bad times. And the government's balance sheet, and that's your balance sheet and my balance sheet, James, like we are that balance sheet. It shouldn't just be there to fund everyday items. And disability support, healthcare, intersection of both of these, which the NDIS is, that's an everyday item. So we've had deficits in 14 of the past 16 financial years for most years just to fund everyday spending. Now, the deficits we should be drawing on at times like COVID when we really need it to protect the economy.
Yeah.
And if we want to have things like NDIS, that's great and it's incredibly worthy and everything. But we've got to find room for it within the government's income receipts, not just borrowing from future generations to pay for services that are needed today. So it'd be nice if this was the start of a new era and just smash society's expectations of the government handout. Start by putting that 20.6 cents a litre back on the petrol price tomorrow. I don't know what fuel's like in Melbourne, James, but it's back at $1.85 or so in Sydney today.
Yeah, it's the same in Melbourne, Anthony.
Well, I know that $1.85 only includes half the fuel excise, but really, James, like it is not wartime pricing. And I'm not sure it's sending the right message to drivers that we need to be careful with our fuel because this is something that's scarce and we're struggling to get our hands on at the moment. We've got to get realistic about the budget. You know, the NDIS would be nice if it was the start of that. I doubt it is, but at least they're finally reining it in.
Yeah, good point. Anthony, I want to bring up a story that I know caught your eye from one of our markets gurus, Gus McCubbing. He reported that exchange-traded funds, and these are the passive vehicles that allow investors to, well, track the entire share market rather than picking individual stocks, they could grow to $380 billion in funds under management this year, up from about $320 billion last year, and back in 2020 was just $71 billion. That is huge growth, Anthony. But it speaks to some broader, really important shifts in Australian capital markets, doesn't it?
It does, James. And what really catches my eye, this is one of the unspoken about changes in Australian capital markets and globally in capital markets. Like when we talk about the rise in passive investing, something that you and I do most weeks, James.
Yes.
We're normally thinking about, this is big super funds just throwing money into the ASX 200 index and letting that money filter down to companies or throwing it into the S&P 500 index. And these are very passive asset allocation decisions. But it's actually so much more than that. And behind these big index funds, we have this giant wave of thematic investing and thematic funds and people allocating money into ETFs as actual active investment decisions. They're choosing themes to investing and they're doing it via ETFs. That's really another element in the market that's sort of changing the way share prices are set, changing the way that stocks trade. It's just getting stronger and stronger and stronger.
So, Anthony, just to break that down a bit, a theme might be something like, here's an AI ETF that collects together a bunch of AI stocks. Or a theme might be, here's a gold ETF that collects together a bunch of gold miners. It allows you to play these big narratives in markets.
Yeah,
right?
100%. So if you think about Commonwealth Bank, for example, it might be caught up in dividend ETFs, quality earnings ETFs, sustainability ETFs, Australia ETFs, banks ETFs, all this sort of stuff. So you might have an investor somewhere in the world thinking, I want to buy some Australian banks, or I want to buy quality Australian earnings, or I want to buy global sustainability dividend leaders. And CBA is kind of caught up in that. So we're talking about the rise of ETFs in Australia, but this is a global story and investors are choosing them as a cheaper way to implement their ideas. Instead of giving money to an external fund manager who might charge them, 50 basis points a year to do it, they can get their idea invested via an ETF for a fraction of the cost and think that's good enough to do the job. There was this report out from the stockbroker Citi last week or the week before, James, and it's talking about US $25 trillion worth of these active ETFs by the end of the decade.
Right.
And we're at about 10 trillion now.
Jeez.
And that 10 trillion now is way more than I thought it would be 5 years ago. So its point is these things are just growing exponentially and they're having a huge impact on markets. Companies are trying to get their heads around it. I mean, it's a big reason why we're getting some stocks that are falling off a cliff on what seem like maybe reasonably small or moderate earnings downgrades.
Yeah.
Investors, it's changing the way they invest. Everyone from big super funds down through to everyday retail investors. These ETFs have just opened up new ways of thinking. And it's all part of the evolution of capital markets.
Because if you are a company, Anthony, and something good's happened or something bad's happened, you want to go and explain it to an investor. Now, that's easy enough if you're going to explain it to a big fund manager or a stock picker, right? Mm-hmm. But who do you talk to at the ETF? You can't talk to one of these things. It's a passive vehicle. There's nobody to say, hey, gee, we did this well, or we can explain that bad thing that happened. That's the problem, isn't it? Does this sort of spell even more disaster for fund managers, stock pickers?
Well, in the near term, it's definitely hurt them, right? And it's hurt their performance in the short and medium term. Longer term, this should all work itself out. You would think that over the longer term, these sort of fundamental deals that they invest along should correct and the passive money will follow them and it should all work out in the fund manager's favour. But we're just not seeing that yet. And we're sort of maybe 5 years or more into this story and the active fund managers are under more pressure than ever. And unless things start going their way pretty soon, it feels like it's going to get a whole lot worse.
Yeah, absolutely. Okay, Anthony, let's get on to our first big topic. And this week, the circus around the biggest float on the ASX this year, and I reckon in many years, got underway in Sydney as the leaders of data centre company Firmus met with fund managers to show their wares. Now, this wasn't a hard launch of the float that Firmus is going to make in the next couple of months, but more like a casual get-to-know-you lunch. Anthony, take us inside the room. What was Firmus trying to do here, and how did it go down with the fund managers of Australia?
Firmus was trying to let the genie out of the bottle, and boy, did it. This racy AI factory builder, Bitcoin miner wannabe not that long ago, it's storming towards an initial public offering and listing on the ASX. It's created immense paper gains for its founders and seed investors and a handful of fund managers, and it wants to turn those into realisable wins for all involved. But we won't have a prospectus out for another couple of months, but the way these things work, James, is companies like Firmus, they have to go out and start meeting investors early, telling their story well ahead of time, so those investors can go out and do their own work, start thinking about where something like Firmus may fit inside their portfolios, and it just gets the IPO ball rolling. So Firmus has taken this pitching process to a whole new level. So we call them non-deal roadshows. As the name suggests, they're not about a deal so much as just going out and meeting investors. Normally they happen with a couple of dozen one-on-one meetings and a few lunches held inside stockbrokers' offices over the course of a week, and it's all good. But Firmus is, like I said, it's at a whole new level. So their lunch on Monday was at the Sofitel Wentworth, a hotel. They had to book a big room in a hotel, 150 seats just to fit everyone in. The stockbrokers' offices weren't big enough. And there's just so many people that want to hear this story. And why? It's because investing's all about the thrill of the chase, right? It doesn't matter whether you're a retired 70-year-old making a few trades once a month on CommSec, or whether you're the biggest, investor in Sydney or Melbourne. It's all about the thrill of the chase, finding the next big thing. Firmus could be the next big thing. I mean, we know that because of the money it's been able to raise in the past 6 months ahead of its IPO. It's raised nearly $2 billion in Australian terms in the past 6 months. That's huge. That's more than any listed company has raised in the past 6 months in terms of equity. That $2 billion, that's all real money. Like, that's not up for dispute. It's not fake. It's actual money that's gone into the business. But it's gone into the business at an ever-rising valuation. And Firmus is now up to, apparently it's worth $7.7 billion. Thinks that number's still going north. And that's bigger than a bunch of companies in the ASX 100.
Absolutely.
So we've got this thing that feels like a bolt from the blue. It's been raising a lot of money. It's now pitching to fund managers for the first time. It's created a huge buzz. And I'm not saying it's a good IPO investment or it's not a good IPO investment or what, but the buzz is there. And it's all because it shapes as potentially the next big thing in a market of people that just want to know about the next big thing.
Yeah, absolutely. Anthony, I need to ask you a really important question. Big lunch, 150 stockbrokers. What was on the menu?
Sandwiches.
Sandwiches?
Probably the same as what you and I have for lunch. Like GYG is great because, if this was GYG, you'd turn up and they'd have burritos.
Doesn't sound very AI to me.
But James, I'm interested, like you called this the biggest float in a generation at the top of the show. Are you talking about size there, or hype, or something else?
A bit of all three, I think. I mean, the size is clearly going to be very big. I'm sure you'll tell me in a minute that there's been bigger floats over the journey. But I guess I'm interested in what Firmus sort of represents. Yes, okay, we've had some data centre operators on the ASX and a few floats in that area. DigiCo last year was one, and it hasn't been all that successful for its investors. This feels a bit different. This is a real AI company with huge ambitions, the backing of NVIDIA, lots of money at stake. And I think, you did a great job this week of bringing the buzz of this thing to readers and listeners. It just feels like a real moment. Is this the moment where we on the ASX have a genuine pure play AI company in our midst? Can one of those companies come to the ASX at a big valuation? Can it be nurtured on the ASX? Can it grow from the ASX and expand throughout the country and potentially overseas? So, I don't know, Anthony, am I wrong? It feels like a bit of a moment, a test. Am I over-egging it?
You're right, it's a moment and it's a test. So in the US, they're having this same debate about a company called SpaceX. Elon Musk's company is trying to raise US $80 billion, right?
Yes.
That's more than what Westpac or ANZ or National Australia Bank's worth. It's trying to raise that for its IPO, and that US $80 billion is only worth a couple of percent of the company. This thing's worth, $1 trillion or more. We don't have those in Australia, but what we do have is we have this quite contentious data center either startup or scale up, depending how you look at it, wanting to raise, I don't know, maybe $1 billion, $2 billion. We'll see at the float at something like $10 billion valuation, which for us, it's really big. But I think you nailed it as to why it matters is because the biggest story in capital markets is AI. This is the turbocharged Australian, highly leveraged play on AI and where AI is going. If you're a believer in AI and if you're a believer in, Anthropic's Claude, OpenAI's ChatGPT, Google Gemini and the rest, they're going to need these AI factories to house their models in. That's where Firmus fits in. It wants to build these factories. But you'll also be backing a business that's got very little track record in actually doing anything.
Yes.
It is still getting off the ground. And at the moment, if you look at it, it's basically a bucket of contracts, and it's done fantastically well to sign huge contracts with some of the biggest players in the world. It's got Meta Platforms in the US, biggest social media company in the world. It's got Blackstone, the biggest private markets financier in the world. It's got Nvidia, the biggest company in the world. It's got CDC data centers here in Australia, the number 2 data centers player by capacity in Australia. It's got great contracts with all those people. It's attracted money. It's in the right place at the right time. But there's still this what are the chances of all this happening?
Yeah.
What are the chances of all this coming together?
Can they pull it off? Yeah, it's a great question. Anthony, I'm just wondering how good the sandwiches would be at the SpaceX lunch ahead of their IPO. But what's interesting is that Firmus is sort of preparing to rattle the tin for investors over the coming weeks and months. But they're not the only ones out there trying to raise capital in the data center game in Australia, are they? There's a real, gold rush is probably not the word, but there's a real rush for investor money.
Yeah, you're right. Gold rush, probably not the worst way to put it. Like the AI CapEx story, it was the story of US capital markets last year. It's continued into this year. We're seeing that in Australia in our own way. Like I said, the numbers here are much smaller than the US, as always, but they're significant for Australia and for the Australian market. I mean, we're even seeing some of this data center CapEx pop up in the business CapEx numbers for the economy and making the economy do better than it was. And Firmus is just one of them. So this week we have NextDC raised $1.5 billion in equity. That's the biggest equity raising in public markets this year. And it raised $1.7 billion in hybrids, $700 million or so subordinated debt, talking about getting a few $1 billion extra off the banks. Add it all up, you've got $5 billion or so it's raised in a couple of weeks, which is nuts. $5 billion is a huge, huge amount of money.
Yeah.
That's just what it plans to spend next year building data centers. Right?
And no one's blinked.
No one's blinked. We've had AirTrunk this week. People remember that's Robin Cooter's company, the one that sold to Blackstone in 2024. Fantastic story that year. It bought a business in India. It's getting ready to expand there. It's thinking about IPOs in Singapore. It's trying to test bond markets in Australia and offshore. It's already got a syndicate of 60 plus banks. It can't really get that much more out of the banks doing lots of stuff.
Yeah.
Then we had CDC data centers here, the company I referred to before, second biggest in Australia in terms of installed capacity. It went out and got itself an investment grade rating this week, James. Now, you only do that when you're about to go to bond markets. CDC says, nah, hold your horses. It's not happening soon, but it's all about funding optionality. And then you have the Firmus IPO roadshow all on top of that. Now, that's all what happened in the first 3 days of this week.
Yes.
We've got the 3 biggest players in Australia, AirTrunk, NextDC, CDC, all either lining up money or getting ready to line up money at the same time. You've got this new entrant in the new world of AI factories, stitching together all these contracts and getting ready to IPO at the same time. It's gone pretty bananas.
Yeah, absolutely.
This is all data center news first half of the week. Then we get to Thursday, and the world's biggest data center customer came to town, Microsoft. The boss, Satya Nadella, he said he's planning to spend $25 billion on digital infrastructure over the next 4 years just in Australia. Yeah. I think Microsoft's spending US $120 billion this year alone on CapEx. Is that $25 billion really going to bite much?
Oh, I don't know. It's a bit like that scene in Austin Powers. The evil villain says, I'm going to spend $1 million. $25 billion doesn't really sound all that much anymore.
Yeah.
Satya Nadella and the Microsoft team were on an AI world tour where they basically flew around everywhere. They stopped off in New Zealand, promised them a big whack of spending, stopped off in Sydney, met with the Prime Minister, promised him a big whack of spending. Now, I don't know how we're really going to measure this spending. It's on digital infrastructure. I know over time Microsoft will sign contracts and already has contracts with several of the data center players you've already mentioned. So there is spending going there. But I don't think they're coming with a big vat of gold coins that they'll suddenly say, here we go. It'll be progressive spending over the time. It'll probably be pretty hard for us to track, I think, which is interesting. But there's a raft of promises in this Microsoft visit. I think they've promised to train 3 million people in AI, and they claim they've already trained 1 million people. So it'd be interesting to see what Microsoft classifies as training. This is the full court press we're getting. You think of what's happened this year. We've had OpenAI, we've had Anthropic, and now Microsoft. All make big promises, all show up and have a meeting with the Prime Minister. So this is the AI gold rush coming to Australia. We're seen as an important market. We've got a burgeoning data centre sector, and we've got the super funds that have got lots and lots of cash that these big hyperscalers might need. So, look, Anthony, I think it's just part of the circus, isn't it? You know, there's a war going on, but it's interesting the level of activity this week says that over time this AI show is going to be much bigger than the Iran show, isn't it?
Yeah, Microsoft's $25 billion announcement, that was like a Donald Trump Truth Social post, James. If I had to rank everything I saw this week from 1 to 10 on the bull dust meter, I'm giving this an 11.
Right.
Like, it's just the, $25 billion big number. Like, what's it actually spending on? There's nothing there. And $25 billion, that actually doesn't buy you much in this world of data centers. Microsoft would have invested way more than that, spent way more than that in data centers here, James. By the time that you buy the chips in the data centers, by the time you pay for the power bills, by the time you pay the rent. I mean, NextDC, it started the week by announcing it had signed a customer for a 250 megawatt contract. Now, 250 megawatt contract, I know that's jargon, but I'm not sure how else to put it.
Yeah.
But whoever signed that contract, could have been Microsoft. If it wasn't them, it was Google or Amazon. They are preparing to spend $50 billion over the next decade just on that one site that NextDC is building. So, I mean, I think Microsoft, what it's doing directionally here might be good, but it's doing the whole AI story, I think, a massive disservice, right? Because you're just chucking big numbers out there at us. There's not actually much behind it. And it's good that the Prime Minister turns up. I mean, this looks like Australia's attracting $25 billion worth of investment.
Yes.
But what are we getting for it, James?
Not sure.
Like, we don't know, do we? Like, what the country's getting for it. We don't know what the tax is going to be behind it. We don't know if this is about setting up a new export industry for us, the AI tokens. We don't know anything. And the most important thing, James, feels to me like we're not going to get much out of the actual data centers themselves. But there's a chance they could help us with all the stuff around the data centers that we really need help with, right? And I'm particularly talking about energy here and the energy transition.
Yeah, yep.
Where's the contracts on that? Where's Microsoft saying we are backing 2.5 gigawatts of new wind farms and battery storage and whatever, and that's going to help you, Australia, so we can run our models here and we can chew up your energy for our data centers. That's the missing piece.
Yeah, to be fair though, Anthony, we struggle enough to get one of those renewable projects off the ground ourselves, the local players here. So maybe Microsoft gets a little leeway to do this over time, but I think you're right. I think it's worth sort of trying to keep tabs on how this $25 billion actually gets spent and how it tallies up.
Okay, James, it's time for our second topic, which could well be called the Walk of Shame. On Wednesday, 2 companies that were once market darlings served up absolute poo sandwiches. Worse than the chicken sandwiches at Firmus's lunch this week, James. First, Corporate Travel Management revealed that the scandal in its British business that saw it rip off its customers to the tune of $80 million has snowballed such that its overcharging is estimated to be $220 million. And the bionic ear maker Cochlear, a great Australian tech success story, plunged 40% in a day after delivering a nasty profit downgrade. James, take us through the Corporate Travel Management story, which read like something out of a crime novel.
Oh, this was unbelievable. It's not often you get a ASX announcement that's like a spy story, but this was one. I mean, let me take you back, Anthony, to April 2021. The pandemic's still very much in the news, and Joe Biden decides to pull out of Afghanistan. It's a bit of a mess, you know. Remember those scenes of people trying to cling to the planes that were taking off? Awful scenes.
Yep.
Britain also withdrew. And the British government handed corporate travel management a contract, a deal to help it with the repatriation of lots of its people from Afghanistan. So embassy staff, interpreters, lots of people. And basically, corporate travel management had to book something like 1.4 million nights of hotel accommodation across 60 hotels across Britain to get this contract done. It was an absolute mess, really complex, all done in a big rush. You can understand all that. But it appeared to be really profitable, at least until late 2022, when all of a sudden corporate travel management figured out there was a bit of a discrepancy, 55 million British pounds, between what corporate travel management had charged the government and what it had actually paid to these hotels. It looked like the government had been wildly overcharged.
Yeah, right.
Now, this 55 million bucks, it went back to the boss of the UK division at the time, a guy called Michael Healy, and it said, oh, what's going on here? And so they started to investigate. They came up with a plan where they would get some letters done that would set out with the British government, here's how these contracts have ended up. Here's the differences. We'll need to make some refunds to you. We'll keep part of the amounts. It'll all work out. We'll set it all out in a letter. We'll get the letters signed, and then we'll all be on the same page. Michael Healy apparently goes away and does this, according to the corporate travel management account of all this. And as far as corporate travel management is concerned, the issue's over. They don't tell shareholders about it, and the world rolls on. We roll forward to late 2025, when all of a sudden corporate travel management is told, oh, those letters that we had that seem to be setting this all to rest? We're not actually quite sure they're real.
Really?
So they go to the British government, they say, oh, those letters, they're all good. And the British government says, nope, no record of them, never received them, don't know what you're talking about.
Far out.
And so corporate travel management realises it's got a big problem on its hands. So the company has been suspended from trade from August 2025 and is still suspended from trade on the ASX. They've been trying to work out, with the help of KPMG, what's happened with this business. The KPMG's done a forensic investigation, the results of which came back and were put into this ASX announcement. And basically what corporate travel management said on Wednesday was that the KPMG investigation has found misconduct on the part of this UK CEO, Michael Healy, and they basically threw him under the bus. The board said, well, we relied on information from him. Our auditors relied on information from him. We're very sorry, but, this is where we're at now. Now, there's a little problem here, Anthony, in that the rip-offs are now to the tune of $220 million.
Okay.
Corporate travel management's cash and debt facility, it's about $190 million. So investors are pretty worried about the discrepancy between those two numbers. Corporate travel management are reassuring everybody that the refunds it has to make, they won't be as big as $220 million. The British government's going to let them pay off the debt over time. They're going to get through this. It's all going to be okay. But at the end of the day, corporate travel management is still suspended from trade on the ASX. It's got this notional value out there of $2.3 billion, but who knows what the real value is when the company finally starts trading on the ASX again. It's a complete mess. The founder and CEO of the company, Jamie Ferris, he left in February, but the chairman, Ewan Crouch, he's still there. It's going to be difficult for him to see out the year, but he's promising to stay on and fix this up over the next few months. It's an incredible mess. Awful disclosure, awful accountability, awful transparency. Total classic Australian corporate scandal.
Absolutely, and it sounds like there's a bit of a debt and deficit story in there, James. And Mark Butler showed us earlier this week what happens there when your eyes are bigger than your stomach, I guess, or you don't have the balance sheet for it. So can this company survive?
I'm not sure, Anthony. It's a good question. What they say is, look, the rest of the business outside Britain's still going okay. Customers are sticking with us. We're generating cash. Obviously, they're rebuilding the governance and controls and risk management process and all that sort of stuff. Does it survive in its current form? Does a competitor come in and try and swoop in and buy this thing on the cheap? I think both of those are live options. I think this thing traded about $16 a share the last time it traded last August. What's it worth now? That's the question that nobody can answer. Is it worth half as much? Is it worth a third as much? Is it worth $2 a share?
Keep going.
That's the bit that, I think the answer is probably closer to zero, but it's impossible to know. And we're not going to know until June. The end of June is when they're hoping that the company can trade again. So watch this space. It's an incredible mess and an amazing story. But Anthony, corporate travel management's a comparative tiddler compared to Cochlear, which started this week as a $12 billion company and ends at, worth about half that. What the hell happened here?
Big story, James. ASX listed corporate story of the month in my book.
Yeah. Cochlear,
bluest of blue chip Australian companies. The Cochlear implant, Professor Graham Clark out of the University of Melbourne developed the Cochlear implant to mimic the coding of sound. That's in the late 70s. They commercialised it, gone global out of Australia. Super duper story. One of the true global champions we've got in Australia. Very, very mission driven, purpose led, great purpose, helping people with hearing loss. Listed in 1995. So not only was there a good idea that they commercialised, it's turned into a great Australian company. Now, for most of the part since 1995, it's grown revenue and earnings each year, and it's a good business. Would have been thought to be one of the highest quality businesses on the ASX. Problem is, though, James, it's been stuck in a downgrade cycle since 2024. So it's basically, it's not selling the volumes it could, should, or would, or has set itself up to do. So it's gone from being a stellar performer into a serial disappointer as far as investors are concerned. And the big daddy of the downgrades came this week when Cochlear said its business across the board, but particularly in the US, has really slowed.
Yep.
And it's gone from expecting $450 million profit this financial year to about $315 million. Now, remember, first half profits already in the bank. So the first half profit was worth $195 million.
Right.
So it's gone from expecting about $250 in the second half to $120 or so. So it's halved.
Oof. Yeah.
Now, it's one thing for business conditions to sour, and Cochlears have been souring a bit lately across most fronts, but it's another thing to be so blindsided by it. And that within just 2 months of it saying in February that profit number, that 450 or so this financial year, just within 2 months of saying that, it's going to halve what it would earn this half. And it made for an absolute shocker. That's why the shares got sold off so hard. So the CEO, Dig Howard, he kind of explained that the business is getting pinched in the US, where patients are under financial pressure and dropping out of getting an implant. It's a couple-month process to line it all up, and they're sort of getting to the end of it, seeing the bill and not able to afford it or not choosing to spend that money. And he thinks that's the new thing recently that has led to the downturn over there. In Europe, there's a mix of sort of hospital wait times are blown out, industrial action in hospitals, which aren't helping them. It's also got the Middle East. But, the Middle East is probably 5 to 10% of its orders at most.
Yeah.
It's slowed down there because of the conflict. So we've got two problems here, James. We've got the actual Cochlear business itself, which the CEO, Dig Howard, says, needs to double down on its hearing loss is a serious problem, not something you should delay fixing message. And then we've got the guidance issue, which just from your and my day-to-day existence in capital markets, this one's a real doozy. You put them together, you get an ASX darling with its wings not just clipped, but torn off this week. The stock's gone from $320 early last year to $95 today. It's down by 2/3. A Cochlear, one of our best businesses. Now, no one ever thought that would have happened. So the earnings forecasts have been smashed now. So it finishes this week. Analysts are saying next year's earnings, the year after earnings, they're going to be 20 to 25% less than what we thought. So there's no quick rebound here. There's no reversal. There's no silver bullets that's going to make this thing into the reliable, great, stellar performer that we've come to expect it. The question then is, so what do you pay for that? If this isn't as premium a business as we thought, what's the multiple you put on its earnings? And James, it's still trading at about 25 times earnings. All right. The market's
still pretty
like
rich.
16, 17 times, it's still a premium.
Yeah.
Now, CSL, which has also come unstuck recently, mate, it was trading up in the 30 times earnings and it's now back at 13 times.
Yeah.
So you can get the downgrade, and the risk here is that they do get further downgrade. So it's a real ugly one.
Yeah, Anthony, I want to bring in a listener question here. I guess it's more of a comment, really, from Craig in Victoria, who sent this in via the widget that's on the bottom of all Chanticleer stories at afr.com. And Craig says, have a look at average days outstanding inventory for Cochlear over the last 10 years. It's all there in black and white. Wasn't a surprise to see them in trouble. They've nearly doubled inventory over the last 10 years, and it's up significantly in the last 3 years. Anthony, can you just explain a little bit what Craig's talking about here, and is it the early warning sign that he suggests?
Yeah, so Cochlear, essentially, it's a hearing device, but it's just like any other widget maker. In its case, it's got very expensive widgets and it sells them, but the more you make, the more you sell, the quicker you sell them for, the higher the price, the more money investors make at the end of the day. Cochlear carries a lot of inventory, like about $500 million worth at June 30 last year.
Yeah.
It was a third of that 10 years ago. So it's built up a lot, and it's particularly built up a lot since COVID, and the sales growth just hasn't matched it. Now, the reasons it built so much recently, it's had a new product launch, so it's sort of stocking that in its own factories before it goes to market with them. Gotcha. And then it was also trying to increase its supply chain resilience by storing more of some of the parts that it's a little bit worried that, if the world goes bad, it won't be able to get.
Yeah.
But the more you store, the higher your risk of obsolescence. There's the risk you're carrying things that you're not going to be able to sell. And there's an actual cost to that as well. It sucks up your working capital in the business.
Yes.
So you're paying for a lot of stuff up front that you're not going to be selling for quite a while. That's an expensive way to do things for shareholders. It's much better if you run GYG and you're making burritos then and there and getting the cash in the door then and there.
Yeah.
And you're not having to carry the inventory as much on the way through. In terms of Craig's question on average days inventory, I mean, that measures how long you're holding stock before you sell it. And yeah, it's blown out, which is very costly for a business. Average days inventory at Cochlear was approximately 320 days for FY25. It was 233 days a decade ago, 285 days 5 years ago. And so it's a little accounting tool. I mean, to Craig's point, it's one of those little red flags you can watch out for. But it tells us that this slowdown at Cochlear comes as it's sort of been building this war chest of inventory. It's been building these products and sitting on them. So it's been hit by a slowdown at the same time it's sitting on more of its products, which is not a good thing.
Yeah, absolutely. Great spot, Craig. All right, Anthony, it's a bit of a sad story. And as you say, it's a shame to see Cochlear and CSL, two of our really big global tech healthcare giants, downtrodden at the same time. But we'll be back after the break. It's a huge week for central banks and interest rates. Back in a sec. Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Now, Anthony, I promised it's a big week of central banking. On Tuesday, the Bank of Japan makes its interest rate decision. And the big question there is whether I spent enough on my holiday to influence inflation in Japan. Yeah, I don't think I did, so it should be okay. No decision tip there. On Wednesday, we get inflation data for the month of March and the March quarter. The inflation rate, the headline inflation rate, is going to reflect some of the higher fuel costs. It's tipped to hit 4.6%.
Ouch.
And it's probably on its way to 5.5% or maybe even 6% in the middle of the year. So this is the start of the bad news for the RBA. On Thursday, the Federal Reserve, America's central bank, also has a rate decision. Again, they'll probably sit on their hands given the cross currents of the war in Iran and the inflationary pressures that's bringing. Remember, the Fed had been expected to cut rates this year, but Anthony, it looks like the Fed's just going to have to stay on hold for most of the year now. So that's another tailwind for the market sort of gone, I guess.
Absolutely. I'm more interested in the Australian inflation number though, James. That's a huge reading.
Yeah.
Right? Only, 2 weeks or so from the next RBA board meeting. It's going to be fascinating.
Yeah, it's a real pinch point for the RBA. Well, we love questions here at the Chanticleer podcast. We had one from Craig earlier. If you have a question you want to send in, you can email us at chanticleer@afr.com. You'll find the link in our show notes. Or you can just send us a question in audio form by recording a voice memo on your phone, including your name and where you're from, and emailing it through to us. And as Craig did, there's that widget on the bottom of every Chanticleer article, so you can send us a question that way too. Well, this week's question is from Julie in Perth, and it's a relatively simple one, I think. I'll get our super producer Maddie to do the honours.
Hello, Chooks. I suspect, like many of your listeners, I'm starting to feel a bit of Iran war fatigue. There's news every day, but has anything really changed? When will we know if this conflict is really over?
That's a good point, Julie. We've had a strange week on the war front, a ceasefire that is now indefinite, but you've got the Iranians and the Americans boarding each other's tankers and all sorts of stuff that looks a lot like the end of the war is not in sight. But Anthony, I got an answer on this from a very senior oil industry executive this week at a function I attended.
Okay.
And they gave me one simple number to watch. That number is 135.
What's 135?
That is the number of ships that were going through the Strait of Hormuz before this war started. And so in this executive's view, it's only once we get back to 135 ships a day going through the Strait that we will know that the global energy industry is healed. So I think it's actually a nice way of thinking about it, at least from an economic perspective. All this ceasefire stuff and all the stuff around talks and the posturing from Donald Trump, all that really matters here is that the Strait of Hormuz gets reopened, and not just reopened a little bit. The Strait can't be ajar. It needs to be fully opened. And we need to see that daily traffic get back up to 135 ships. Any other things Julie should watch?
I agree with Julie. It's impossible to know. Both sides also shaping up to each other. The market, for what it's worth, Julie, and I don't know if it's worth much at all, but the market's looking straight past it. Thinks the worst is well behind us.
Yeah, and they're all focused on AI and Firmus's chicken sandwiches. All right, Anthony, well, we've talked a lot about food on today's podcast without actually mentioning the food industry, and I'm feeling a bit peckish, so I think we should wind it up here. Thanks for your hard work and great insights, and Anthony, we'll see you next week.
Catch you next week, James.
If you like the podcast, send it to a friend as it helps other listeners find us. And don't forget to follow wherever you get your podcasts so you'll never miss an episode. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people. Chanticleer was hosted by me, James Thomson, and Anthony Macdonald. It was produced by Mandy Coolin. Head of audio is Alex Gow, who also composed our theme. And the head of premium content is Fiona Buffini.
The Australian Financial Review.